COVID-19 brought the world to a standstill. Nearly 2 million lives lost. The global economy paralyzed.
We anticipate the worst economic fallout since the Great Depression.
The pandemic is changing the way we live and work. While the virus rages, violent mobs storm the U.S. Capitol, threatening democracy. And in Europe, Brexit ushered in a new era. But a new year and an unprecedented global vaccination campaign are offering hope. What will the year ahead look like for our society and economy? Will the travel and hospitality industry recover? Can technology unite us instead of dividing us further? Reconvene the biggest names across finance, economics, technology, and public health to create a blueprint for a future that's more resilient, sustainable, and equal. Join us for what's next at the Year Ahead Summit.
Hi, everyone. Welcome to the Year Ahead 2021. I'm Shertia Brantley, Deputy New York Bureau Chief and Senior Editor at Bloomberg Live, and I'm excited to be your host today. At the Year Ahead, we're bringing together leading CEOs and global influencers from a range of industries: retail, travel, finance, healthcare, and technology, to map out a blueprint for global economies as the world recovers from the pandemic. And now I would like to acknowledge our sponsors, Alex Partners and IBM. Before we go further, I have a few housekeeping announcements. Tech issues. If you experience any issues with audio or video quality, refresh your browser or use the chat box in the bottom right corner of your screen for support. Please engage with us on social media using #TheYearAhead and engage with other attendees in the event chat in the bottom right corner of your screen. We have an incredible lineup of speakers, but before we hear from them, a message from the founder of Bloomberg LP, Michael Bloomberg.
Hello, everyone. Mike Bloomberg here, and it's a pleasure to introduce this next conversation, which I know you'll enjoy. As we think about the year ahead, we all know what's at stake. Across the world, the need for leadership is unprecedented right now, and so are the opportunities that leaders have to make a difference. Countries need to rebuild from a devastating pandemic, and they have a chance to do so in ways that also make their economies stronger, more resilient, and more sustainable. And climate finance can play a critically important role in helping us do that. I say that from experience. I chair a group called the Task Force on Climate-Related Financial Disclosures, or TCFD for short. More and more, the TCFD framework is the go-to guide for investors that want to shine a light on climate risk and help allocate capital more efficiently and productively. I've worked on this issue for years now, including with a guy who knows a little something about finance and managing a global crisis, my friend, Hank Paulson. In fact, Hank serves on the board of my foundation, Bloomberg Philanthropies. We're very lucky to have him, and so is TPG. Like all of you, I was surprised to hear that Hank was taking on a new job. I think Hank was surprised too. But let's face it, after Bono and Jim Coulter came calling, it would have been impossible for Hank to say no. As I'm sure you know, TPG is doubling down on its climate investment strategies. The new global fund is called TPG Rise Climate, and I'm looking forward to seeing what Hank and Jim are going to accomplish together. Rebuilding the global economy and winning the fight against climate change really do go hand in hand. To tell us more, I'll turn it over now to TPG Rise Climate's new executive chairman and managing partner, respectively, Hank Paulson and Jim Coulter. Hank and Jim, take it away.
Well, hello, everyone. I'm Jason Kelly here with a couple very special guests, very timely guests, as we think about the year ahead. Top of mind, for sure, is climate. I'm joined by Jim Coulter and Hank Paulson, two very well-known names in the world of investing, in government, in global politics, in all of it. Jim, I'm going to start with you because you and I have done this for a few years. This is fun to do again with you. We think about the year ahead. We hear what you're saying to your investors. This year, we thought we'd do something a little bit different, and we talked about focusing in on one issue. We talked about you bringing a friend, and man, you delivered. Well done. Gold star. Tell me what's going on here.
Good. In the past, Jason, when we've talked, we've brought you a whole set of themes that were interesting us. And right now, we really want to focus down on probably the biggest thing I see happening in the markets, the biggest thing for what may be the next 20 years of investing, and that is the total rewiring of the economy for a non-carbon environment. Now, we've been talking about this for a while. We've been talking about the why of impact investing for a while. What we haven't talked about is the when and the how. So I think we're here today to focus on the when and the how. Let me begin with the when. The when is now. And what happened, Jason, is bottoms up a few years ago, we started to see a change in our deal flow for climate investing. And four forces really came together. Four forces that had been lurking but hadn't quite reached their full power. The first is the net zero pledges. We have 30 trillion, let me just repeat that number, 30 trillion of government net zero pledges. We have 1,500 companies that have made net zero pledges, and yet none of them can say how that's going to happen. The second thing that happened is consumers now get it. It's kind of the Greta phenomena. 55% of the growth in CPG products have been in sustainable products. People are willing to put their pocketbook where their beliefs are. Third thing that happened is investors started to pay attention. Everyone from Larry Fink to the Canadian pension funds have said this is at the top of their list for how they are going to think about the responsibility of companies. The fourth thing, and this is the thing that I saw and got me truly excited, is a technology change. 90% down in a decade in solar costs, 60% down in onshore wind, 70+% down in battery costs. Suddenly, things that used to require subsidies can just be done on pure capitalism. And so it's time for pure capitalism to step up. And this is the big theme, not only today, but I would argue for the decade ahead.
And thus, TPG Rise Climate is born, and you are the managing partner, and the executive chairman, Hank Paulson, is joining you in this. So, Hank, how do you get involved in something like this? It is a big deal for you to make this sort of move, given your experience and given all the ambitions that you have around these issues.
Yeah, a good question, because I care deeply about the issue. And so when I left Treasury, I worked very hard on climate and environmental issues, but I did it through various NGOs that I chaired or co-chaired and set up, and focused on U.S. China and with the Paulson Institute and Economic Strategy Group, a number of these. And because I just see climate as the most certain, formidable risk that we're going to face. And so I was approached by TPG. I've long had a high admiration for Jim and his co-CEO there, John Winkelried, worked with me for years at Goldman Sachs. And as I talked with them about this opportunity, it was just clear to me that it is a huge opportunity. And I thought, I could combine my policy work by doing it with a big pool of capital and make a difference. Because the thing that is just so obvious to me is that as we rewire society, it's going to take a huge amount of capital. And that capital isn't going to be there if it's just for a concessionary return. It's going to take, full returns to attract the private capital necessary. And, there's a great opportunity right now, because right now, for the reasons that Jim mentioned, there is a huge opportunity, and there's a hole in the market, because when you look at the market, you look at all the public sentiment, look at the public money, pouring into Tesla. And you've got venture capital and you've got contracted renewables, but there's this big opportunity that hasn't been filled to really build outstanding private companies that make a difference in climate change. So to me, that was an opportunity. The other thing I would add to what Jim said about what helps bring this all about is the public. He mentioned the public. And why is the public so focused today? You look at these climate shocks and disasters all over the United States, the wildfires, the droughts, the heat waves in Asia and Africa. And people are alarmed and people want to see action. And that helps drive business to action and it helps drive governments to act.
And so, Jim, let's talk about that middle, because that seems to be the key here. Give me some examples of what that looks like and what it looks like at scale.
Right. So the question is, how do you take the very good work that has been done in the venture world and bring it to scale? And we're used to the digital world, Jason, where that happens pretty easily. Just put it out on the internet, it goes. One of the real challenges of the climate world is going to be this takes physical scaling. So this is an area we at TPG know well. We were early investors in Airbnb and Uber as they came out of the venture world and until they scaled and before they hit the public market. And that's the area that is probably less developed today than it needs to be for the amount of capital that is required. So let me give you an example of some of the things we're doing. We just announced a investment in a company called Element, which essentially is one of the largest producers of carbon credits doing renewable natural gas. The whole carbon credit market is going to be one of the most fascinating markets of the next decade. It's going to be Bitcoin with substance, because we're going to have to speak in these credits almost as a new sort of currency for the non-carbon economy. We recently announced a SPAC deal around a company called EVBox, 190,000 charging ports across Europe. Think of it as Peloton. It's not just the hardware, it's the software that ties those together in a way that saves energy costs. We're doing a gig of development of solar across Peru, the U.S., and in Europe. We are the largest producer of rooftop solar in India. So if you begin to get into this, you realize that climate is not one thing. It's across vehicles. It's across greening industrials. We built a brand new steel plant that is 90% more efficient. So 30 years ago, if you were an investor, Jason, you would have said, maybe this digital thing is a big thing. I might want some specialized capital against this digital revolution. And you probably would have underestimated just how big it was. The next 30 years, I believe that the climate revolution will very much mimic what happened in the digital world. We're going to have new business models. Hank and I were laughing the other day. In some ways, Tesla may be AOL. Not how it ends, but this is the first of many new models in many new areas. We haven't yet created the Google. We haven't created the Facebook of the climate revolution. Those things should be created between venture capital and the public markets. One of the risks right now is that they're getting to the public market too soon because the private market isn't as developed as it should be.
And so, Hank, talk to me about the public side of this. We're talking about a week after the United States went back into the Paris Agreement. China obviously is a huge piece of this. Tell me how governments, especially governments in 2021, a new administration here in the United States, how does that play into this opportunity and how do you leverage that?
Well, first of all, it's huge because Joe Biden ran with climate change being an important part of his agenda. And climate diplomacy is going to be an important part of his agenda. And the things we're going to see done in the United States are going to make a big difference, but around the world. So he has a historic opportunity and a historic need to restore global cooperation. But I will say that Paris, as important as it is and as essential as it is not sufficient, because Paris, governments make these pledges, these net zero pledges, and the only thing they're obligated to do is to report regularly on whether they're going to meet them. And these are going to be terribly difficult to meet. Right now, we're not on track to meet the pledges, and even if we met them, the world would overheat. So that's why it is so important to have climate finance be developed and continue to be developed and make the advances. And so, and I can think of, you can think of all kinds of examples. If you look at China, that is by far the biggest carbon emitter, and they've pledged, they're going to peak their carbon at 2030, carbon neutral at 2060. That's very ambitious. And so just understand, Jim talks about rewiring an economy. Just think what that means for China when you've got these, the largest manufacturer in the world, they'll be the largest economy in the world, and you got all this heavy industry, the petrochemicals, all the heavy manufacturing and steel and cement, and and how you redo that. It's going to take massive amounts of investment, trillions and trillions, and out of that investment is going to be some tremendous opportunities to make very big profits, which then will be necessary to attract more and more capital.
And so, Jim, from a competitive landscape perspective, how do you tackle that from the finance and investing perspective? You helped, birth the modern private equity industry. You saw that get more and more competitive. Right now, candidly, this doesn't look that competitive. There aren't that many funds out there doing it. How does that evolve in the short term from your estimation?
Well, there aren't a lot of specialized funds doing it. People are touching on it, but just like you want specialized capital for the digital revolution, we need to build specialized capital here, because once you get specialized capital, you get a flywheel of knowledge and opportunity. So let me touch on why we're treating this as a problem to be solved as much as an opportunity. It's clear that the finance markets have to reflect this need for capital. And the other side of that coin will be an amazing opportunity. And if we're successful, we'll funnel more capital. So Hank and I view this as an opportunity to generate extraordinary returns, but also as a mission to generate those returns to bring more capital. And that flywheel is what needs to get going. And so we started this effort really over a year ago to look at how would this problem get solved. And we realized that we needed a few things that you wouldn't normally need in private equity. First of all, so much of it is going to happen at the intersection of business and policy. So having Hank join us is, I think, a very important move. Last time the world had a crisis of business and policy and government coming together, Hank was there and helped us through. This is another crisis, and we're really pleased to have him focus. All of us ought to be pleased to have him focus on this intersection. The second thing, though, is you can't just do a startup here. This needs to happen now. So we started building a portfolio several years ago to prove to ourselves that it was happening and that we could scale it. So we're now taking that portfolio and raising specialized capital around it because you need to move quickly here. Which brings me to the last point. We're doing this, building it on the chassis of TPG. So again, we want to live between the great work that's been done in venture capital, the great work that's going on the policy side, But our job is to take these ideas, get capital to them, scale, and build returns that will get the flywheel going. So it's both sides of the coin. There's a need and there's an opportunity. We're connecting them.
So, Hank, Jim took me right where I was going to go, which is this notion of managing through a crisis. You arguably managed through one of the greatest crises of our time, if not the greatest crisis of the time, the global financial crisis. How do you use that playbook to deal with something that is also literally existential here? What sort of experience do you draw on? What are the lessons from that can be applied here?
Well, I tell you, this is more difficult and more insidious because crisis management is easier when it's immediate, right? And it's easier when it's domestic as opposed to global. And this is global, and it's longer term. And so those are two things that make this difficult. But I think that we have, so in many ways this is different. But I tell you, the crisis is one that people are seeing, every day around the world in terms of these climate shocks. And so I think that there are certain similarities. Like, for instance, it takes the public sector, it takes governments working with markets. Okay, and so I think that's going to be a big part of this, and I do think there's a sense of urgency, and people are going to increasingly see that urgency, and so to me, I'd say those are the biggest similarities. But I would say one thing as I look at it that I think is going to be very difficult to do and is going to be important, and that is I think we need to take Paris to the next step, and that's going to be largely governments, because we're going to need something that's focused on the big economies, not every economy, the big economies, and it's going to have to deal in a very straightforward way about free riding. And it's we're going to need things that have real teeth in them, and discourage free riding. So I think we're going to need new mechanisms to bring major economies together, and I think that was the frustration that I dealt with in the financial crisis, because it took Congress being able to see the crisis spreading from banks to Main Street to get Congress to act. And so what it's going to take here, which is going to be more difficult, it's going to take the world seeing this accelerate to really, and to have the publics in each one of these countries push their nations to do something that's got teeth in it. But here, I would tell you, I think what we are doing right now has got the potential to make a real difference. Because I think as you see progress being made, you got to see progress on the ground, and investments being made that make a difference. And the thing that Jim didn't mention yet about the TPG Rise Climate Fund is the Y Analytics, because that was very important to me, that we're not just going to get a big return in terms of profit on capital, but we're going to get a big return in terms of climate emissions avoided, carbon emissions avoided. And there are some really cool mechanisms that TPG has developed to measure that. And I think when you can measure that and show progress, it's easier to get governments to act. And I think if you could come to governments with a big pool of capital, it's easier to get them to act.
And so, Jim, to that point about pooling capital, how would you describe the sense of urgency, or maybe more pointedly, the sense of appetite on the part of institutional investors to invest behind this? Is there a comparison that you would make here?
I think the awareness in the institutional investment market is very high. What they're lacking is the solution for how to approach the market. If you look, Jason, into the public market, ESG ETFs, which are largely driven by the E, have been one of the most attractive performing and hottest parts of the sector because people are trying to express this idea. And what I think needs to happen is all parts of the financial world, from green bonds through ETFs, through sector funds like we're talking about, through the venture capital world, all of these need to be enabled and enacted in order to meet this challenge. And it needs to happen relatively quickly. We have to prove the returns. The returns will only be proved in the rearview mirror, as Hank likes to say. But we want to make sure that we make it clear that this will be focused on the market joining with government to help this to happen. And for me, the ability to bring those two together is the two sides of that coin.
So, Hank, go ahead, Hank.
I was going to say, and to do it the way TPG is looking to do it globally. So there can be learning, climate solutions that work in one nation can be used in another. And so the investors in this fund, one of the things we love about it is the investors, we'll have smart investors that will help give us ideas, and we will get, and they will have a window on what's happening around the world. And that will accelerate the progress.
So, Hank, I'd be remiss if I didn't ask you about a potential player in all of this, which is the newly confirmed person who is sitting in your old seat, Treasury Secretary Janet Yellen. I would imagine this is on her to-do list. What role does the Treasury Secretary play here in the United States? What advice would you give Secretary Yellen here?
Well, first of all, we are all really fortunate to have her, someone with her experience, and she's close to the president, and she's got all the interpersonal skills and she was confirmed with great bipartisan support in Congress. So I think she's got a very difficult job, but she's very well equipped to do it. And she understands climate change, cold. She's been looking at it for a long time, and finance has a big role to play. And so she will have a big role to play. It is at its heart, climate change is an economic issue. That's really what it is. And so it's something that falls squarely on the Secretary of the Treasury's plate. And so globally, as the Biden administration works on it, she'll have a big role to play. And of course, here in the U.S., once we got to get through the night first. And, so her biggest problem is, the U.S. economy, fixing the U.S. economy, which will be relief and stimulus on the front end. But then the recovery, a big part of the recovery is going to be investing in our long-term competitiveness and preserving our economic security. And climate and green investing will be part of it. And so, again, we're fortunate to have her, and she's got a huge job in front of her, a very difficult job, but boy, we can be all grateful she's agreed to take it on. And I know for sure that climate change is going to be an important part of her agenda.
So, Jim, as we begin to wrap this up, I do have to ask you, you're in the business of risk and opportunity. What's the downside here? What do you worry about as you get this thing launched and all put together, you continue to do deals? What do you worry about the most?
I think the biggest risk is, of course, inaction. Because I think there was a risk for a long time, and I think this bit a lot of investors of being too early. But what I'm here, I think, and what we're telling you is that we're seeing bottoms up, that it's happening now. So the risk is for investors everywhere not to express this in your portfolio. It will be volatile. There's a chance that some of the runs that you see in the market will echo what you saw in the digital period where occasionally the market will get ahead of itself. But the long-term trend that gave us Apple, Google, Facebook, Instagram, Salesforce, that trend is going to play out, and it's all in front of us. So the risk is for investors not to have an opinion on how they're going to participate. And the risk for our country is to fail to participate. To your point, Hank, Department of Energy tells us that renewable energy has 5 times the job creation of fossil fuel. So we need to do this not only from an energy point of view and a climate point of view, we need to do this from an economic point of view. So there's a risk of being early. I think we may be past that risk. There will be a risk of volatility, but we have greatly reduced the risk of this isn't happening. It's happening, and it's happening now.
And another way of looking at that is the risk to our planet. And when you look, which is incredible, and the risk to the planet is so great, you know that the investment has got to come for that. So that's just a certainty. Otherwise, we're going to self-destruct.
Well, on that note, I think we're going to have to wrap it up, but I'm optimistic about what you guys are doing. Hank Paulson, really nice to see you. Jim, thanks for coming back once again and helping us think about the year ahead in a new and different way. Year 4, here's to year 5. Thank you so much, both.
Well, it is a great joy to be at Bloomberg's The Year Ahead with none other than Delta CEO. It is Ed Bastian. It is always a joy to speak to you, sir. Wishing you a happy new year. It almost feels an age ago that the new year started. And it's an interesting one as we look down the barrel of 100 million COVID cases globally, as we see variants rock through where I sit now in the UK and London, spread globally. But some sound of optimism from you as we do see the vaccine being unrolled unevenly at a large part. But where do you see the impact of COVID going for you, for your business, as we enter 2021?
Well, thanks for having me, Caroline. It's always good to talk to you and good to be part of your program. We just finished 2020, which was in the travel industry by far the most difficult year ever. For us, and I'm really proud of how our team has fought through, protecting people, protecting our customers, getting the very best medical advice and counsel as we work through this pandemic, and we'll continue on that pathway. The vaccines hold great promise. In our country, we're over 1 million vaccinations a day is the run rate that we are currently at. We anticipate by spring, we're going to start to see an inflection where the virus will go into a much more contained state. People will feel much more comfortable starting to get their life back. It won't be normal at first, of course. It's going to take some time to work towards it. But over the next 90 days, I am optimistic that we're going to come out of this lockdown period. International borders will start to reopen, and we'll be on the other side of starting to gain real victories against the virus.
What does that normal look like? If I get on a Delta plane, will the middle seat still be blocked? Will I be wearing masks? How does it make you feel? What will traveling look like come that?
Yeah, so I think travel will feel very much like it feels today. All the safety protocols will stay in place, the mask wearing, the electrostatic spray fogging, the cleanliness, all the filtration processes. We right now are blocking the middle seats through the end of March. We have a decision to take as to whether we continue to advance that, which we're looking at now, and we'll probably making that decision in the next couple of weeks, how much further we could consider returning, because we don't want to start selling those middle seats really until people feel comfortable sitting in those middle seats. We know medically it's safe to sit in the middle seat, but we want our customers to help guide that direction rather than us making that decision unilaterally. So, watch out for that decision. It's coming soon. But the bottom line on it all is we're taking really, really good care of the protection of our people, and that's not going to change. We're going to, as we go through the spring and summer, we're going to continue to stay very vigilant about protecting against the virus, because we know as we go through this year, it's the virus isn't going to go away. It's going to maybe move to a lower state of remission, but there's still going to be some drumbeat of virus in the broad population that we have to be mindful of.
It's interesting, we've actually got an audience question on that note, asking about, well, if we're going to perhaps still have the safety measures, the social distancing, the masks, what about some sort of travel document you'll need to say that you've had a vaccine? Is that in any way going to be a realistic assumption?
I think it will be for international travel. I don't think for domestic travel it's practical. We're carrying at Delta, we're carrying over 1 million people a week now. So I think on the domestic system in the U.S., nor do I think, say, domestic within continental Europe, it'll be practical. But for international, I think it's probably going to be required by the international authorities in terms of opening up borders. Right now, as you know, testing is a requirement to come into the U.S. as well as many other countries, which we support, we endorse, and it's going to cause some delay in the return of travel because of that, but we think it's prudent. But eventually, hopefully, that will move into a vaccination, and we're working on a technology platform by which people can easily show their vaccination record.
And when you're saying there is this pent-up demand, you've already got 1 million being flown within domestically, how much, when the new normal comes, when we see this inflection point, when people have the comfort to get on planes, is it going to be for the holiday that I'm desperate to have and I can't? Is it going to be for business purposes and I'm going to be able to start have these conferences once again face-to-face? How does that impact your business? Because Delta was so much focused on the business traveler.
Yeah, I think it's going to be all of the above, though they'll come at different phases and different paces. I think the seeing your friends and family and getting away for a trip just to escape the monotony of the lockdowns will be the principal driver initially. People just want to get away. They want to go to places they haven't been able to get to for some period of time to escape the challenges of the past year. Businesses will be a little slower in the pickup. I don't know, the pace of recovery. We polled our own big corporate customers just a couple of weeks ago in advance of our earnings, and got a sense from them. 40% of our customers said that expect their businesses to be fully back in travel by 2022. Another 11% said 2023. And 45% said they're not quite sure yet. They're still figuring out. Interestingly, only 7% said it will never return to the way it was in 2019. So you hear all the doom and gloom prognosticators that business travel is never going to return to where it was. Only 7% of the people that actually make those decisions are saying that. So I think you'll see more like what it was in 2019. Eventually, over time, it's just going to be a pacing activity as people get more confident being back out in public. I'll use myself as an example. I've been flying throughout the pandemic. The early months, there was a lot of apprehension as people, looking around in the airports. It felt like a bit of a scary place to be. But now, the people that are traveling, they've adapted. It feels very normal and very safe for most people traveling. So as people come into the system, it's going to take them a while to adjust. But I do think we're going to see their conferences may be a little longer to come back, unfortunately, but they'll come back. They will come back.
And you're saying people have adapted. Your business, how has it adapted to perhaps 11% not doing the business travel you anticipated until 2023, that the 40% still undecided?
Yeah, well, we've downsized our business. We've reduced our total seats and planes by about 20%, and we've also offered early retirement packages. So about 20% of our people also have retired from the company. So we've already adjusted the big cost drivers, the big fixed, structural costs, the people and our fleet to accommodate a slower return back to the new level of normal. So I think we'll be very easily making the changes that we need to make to adapt to it. We're also seeing, though, that customers, when they are making the decision to come back, are telling us that there's going to be a surge when it does come. I think there will be an initial surge. I think there'll be a leveling out, maybe in a year's time, and then probably a new level of surge. Probably international is a year away from thinking about when the real surge is going to come. But the domestic surge, we've got to be ready for this summer, and we are ready.
And of course, this is a health crisis that we live in, but it's become a knock-on economic crisis. As you say, you've had to look to your people, and I know that they've been incredibly adaptable and looking to take early retirement and taking unpaid leave as such. How do you see the economy rolling out and supporting your business going forward? Are you worried about it?
I'm optimistic. Internally, within the U.S. anyway, we're looking at about a 6% GDP growth for our country, assuming the vaccines roll out as we're anticipating they will. That's great for travel. Travel, I think, will be a much higher contributor to GDP since we took a big drop down over the last year. And it's not just obviously air travel. It's the hotels, it's the theme parks, it's the casinos, it's the cruise lines. They're all such big contributors. Our industry broadly is the single biggest contributor to overall GDP in our nation. So when you see the nation's going to be up 6%, that means travel and hospitality is going to be up, probably a meaningful increment to that.
It's been such an extraordinary year now and coming into 2 years, Ed, because it's not only been a health crisis, but it has been a social crisis, an economic crisis, but also a political crisis that we've just seen unfold on this side of 2021 in the United States to January the 6th, etched in everyone's mind as to what happened in terms of on Capitol Hill. Your perspective now on Delta's role within politics, how you see politics unfolding. First and foremost, how do you like the new administration, what they're being announced in terms of supporting the rollout of the vaccine? Of course, I'm sure is music to your ears, but some of the restrictions in terms of travel, some of the mask mandates, does it help or hinder you?
It helps us a lot, Caroline. It's one of the things that I've been seeking for the last year. The reinforcement of masks, for example, getting a federal mask mandate puts our people in a position that they're backed up by the federal authorities. We've had to put our own mask mandates in place just on our own policies, and having the federal government's guidance and support on that, does wonders and helps compliance at a much higher level. Testing, we've been a big advocates of testing for a long time to open up international borders. I'm pleased to see the testing policies the new administration is adapting and adopting going forward. So I think the incremental support and the guidance that the federal government, that the Biden administration is providing and will continue to provide to contain the virus and to defeat the virus is going to be very, very helpful to our business. Yes, it creates in the current moment some choppiness in demand. We've seen a lot of the near-in demand that we've had internationally, such as Mexico and the Caribbean, has pulled back because there's not testing supplies in those countries, or if someone's just going for a 3 or 4 day trip, they're wondering whether they should stay local versus go international, which is understandable. But by putting those policies in place, we at least now have a framework to give people confidence that the borders can be reopened safely, and that's a sign, for the long game that they're doing the right thing.
For moving on from politics of just a new administration, but politics in general, you must have had to look at the way in which Delta has a relationship with politics, a spending on politics. Have you reassessed that since what happened with the riots and indeed the way in which certain congressmen and women acted before, in the midst and after that?
Yeah, no, absolutely. And we have paused, all political contributions from our PAC to any officials as we reassess. To your point, exactly, understanding what we have just been through. We have been through an existential crisis, within our country, driven by the politicization of the elections and the questions that resound still. When we give donations to elected officials, we want to make certain that those are officials that reflect the values of our company, that we are in sync with what they are promoting and stand by, and that they're an effective advocate for our industry, for the aviation industry, in terms of what needs to happen on the Hill. And the events of the last month inform that judgment.
Talking of existential crises, one that the Biden administration is very focused on, of course, is that of climate change, of policies that focus on a greener future. That was an interesting commitment that Delta made. Big spending, about $1 billion, right, in terms of making your company greener. How have you been able to ensure you can keep on that investment when you yourself, I'm sure, in the midst of March and April, felt that Delta was facing down an existential crisis of its own, and how you decide to invest within that?
Well, there's a lot that we've been through this year with the pandemic, and the one thing that I think we can all appreciate is that we have a newfound recognition for wellness, for resilience, for health, and aware of what it's going to take to have a sustainable future, and in terms of whether it's protecting our employees, protecting our customers, or protecting our planet. And I'm proud of the decision that we took a year ago to ensure that we're investing in carbon offset technologies that will go back and recapture the carbon that we have used over the past year, and we are staying firm to that commitment. So no, we've not changed or blinked at all. Obviously, for this past year, the amount of flying that we've done is dramatically lower than what we were scheduled to fly, so the commitment within the year is lower, but we are carrying forward and we'll be making investments in the coming weeks and months to give recognition to the carbon that we used last year, and we're going to be making investments, and we'll be letting and being very transparent about what those investments are, so people can see how Delta is continuing to abide not only by its commitment, but continue to hopefully inspire others to join us on this journey.
It's so true. If you can't measure it, you can't change it. And it's actually interesting that you seem to be holding yourself to account on that, not only when it comes to the climate, but also back to your people. Talk to us about the social aspect of 2020 and 2021. I'm sure as a man who lives in Atlanta, Georgia, as a company that is based in Georgia, you've been very much aware of the social tension, the pressure that has been there, and the response to your people. I know that you put out a statement on Martin Luther King Day to reaffirm that commitment you have in terms of the focus that we now have, that the racial awakening and recognition we've realized, and the change that needs to happen. How are you measuring yourself, and how are your people responding to it?
Well, we are measuring it, and we're continuing to affirm that, and it's a long journey, right? It's making sure that one of the learnings that we had over the past year was that we needed to increase substantially our commitment to those that have been harmed over time, which was more visible to us over the past year than ever, because we had stopped. You know, we could see with our own eyes where the inequities really sat, and for us, it clearly was with the Black and African American community. We've increased the amount of hiring towards Black leadership and roles and developing. We made a commitment. We're one of the founding members of 110, a great organization that Ken Frazier has started, and I've been talking to Ken and Ginny Rometty, who is helping Ken on that journey, and ensuring that we're finding creating the new jobs for Black colleagues and leadership opportunities into the future. We've gone through all of our hiring slates. We've ensured there's no bias, and continuing to make sure that the qualifications that are required are absolutely essential. And importantly, Caroline, we're continuing the learning. This is not something that we can say that we now understand it. You know, we need to, so whether it's with our own employees internally, and I'm spending a lot of time with our own Black employees, continuing to reflect as to where we go, or if it's with leaders that are teaching us what we've been through. Last week, I had the great pleasure of being with Ambassador Andrew Young and doing a company-wide town hall with him. And Andy he lived. You know, he walked the streets with Martin Luther King, and he was one of his compatriots. He's one of the last remaining colleagues who was there, and you know, he gave a beautiful summary to our people, reflecting on MLK on the commemoration of his birthday. That when he died, because Andy was there with him when he died, you know, he saw his body lose its life, but he also saw its spirit unleash that day. And his point to all of us is that his impact on all of us today is far greater than it was back in 1968 when he was killed. And so that's living evidence that the spirit of what Martin Luther King stood for is now our responsibility to continue to carry out in our community, particularly here in Atlanta, the birthplace of the civil rights movement in our country.
Talk to us about spirit. Talk to us about leadership. You yourself as a leader, what do you think 2020, and now as you look down to 2021, what have you learned about yourself? What will you do differently, do you think?
Oh, I've learned a lot. You know, it was a humbling year, certainly. It was a year that we had entered thinking that we had lots of answers, and we already had our plans, and in space of 30 days, those plans were waylaid, and we had to redevelop what we stood for. It gave me an opportunity to reflect on purpose more than ever, the purpose that our people provide, the role that our company serves in society. And one of the reasons I'm optimistic, people say that, despite all the craziness out there, I'm still optimistic. And I am optimistic because I know the pain that we are all experiencing from isolation, from the fact that we can't be together, we can't be with loved ones, we can't be in person. We've got to protect that isolation, and the fact that it's had a big impact on our products, our ability to sell our products, tells me our product really has great value in society and in the world. And our product, at Delta, we like to say no one better connects the world. Well, that's needed more than ever. And so when it is safe, as it will be hopefully over these next several months for people to start to pick up travel again, our product will be in high demand, and it'll serve an essential mission in life in terms of bringing the world through the greatest crisis we've seen in many, many years. So that's why I have confidence that Delta's going to come through this leading the way and being an advocate for unity rather than the challenges we face today.
That was so beautifully put, Ed. I want to ask you just lastly, because we have got a question from the audience that I'm desperate to get to, in terms of that response to your consumer, the need that you see, our desire to connect. How are you looking to reward those stakeholders right now? People depend on their travel points and different ways and means of ensuring that they spend their money with you. Have you been innovating in that respect once you hit the ground running and we're all desperate to get back on the plane?
Yeah, well, there's going to be great bargains. There's going to be great. There's a lot of seats in the marketplace, and pricing is
okay?
Is weaker.
The bargain side, though.
Yeah, it's okay. It's okay. We understand it's going to take some time for travel to continue, for people to have confidence in travel. It's interesting. The customer base that we're carrying today is a younger generation. It's a younger demographic. They're more seeking the adventure, so they're more price sensitive, and they're getting great bargains. We're taking great care of them through that journey. But there's going to be, as travel comes back, there's going to be some great opportunities. I think the hotels, the cruise lines, everyone's going to be wanting to incent travel. And so for those that want to get out on the wave of starting to get out and fill that pent-up demand, there's going to be opportunity there. And it's okay. It's okay that pricing will take a while to catch up to where demand really needs to be. But that's one of the things that we do. We're a supply-demand-driven company. And when the demand comes, that's when the opportunity can firm up pricing, but for now it's okay. Pricing is going to help lead the recovery.
Here's hoping for that demand. Here's hoping for me being able to jump on a plane in London and get back to New York. And here's hoping for more conversations with you, Ed Bastian. We want to thank you so much for your time, for the perspective on your people, on your stakeholders, and on politics and a whole lot else when it comes to health. Thank you, and keep well yourself.
Thank you, Caroline.
Hi, I'm Joel Weber, the editor of Bloomberg Businessweek. It's my sincere pleasure to speak with Adena Friedman, the CEO of Nasdaq today. Adena, welcome to the year ahead.
It's great to be here. Thanks, Joel.
We'd also love to hear from all of you. Please submit any questions you might have in the chat, and I'll do my best to field a few. And just a reminder to use the hashtag the year ahead on social media. Adena, so obviously we're going to talk about the year ahead, but I also just have to start with the market this week and Reddit's GameStop obsession. Where does this go from here, and how does Nasdaq handle moments of extreme volatility that's that have also prompted some of these trading halts?
Sure. Well, I think that that is one of the mechanisms we have, but generally speaking, we don't really comment on any particular listing, particularly those that aren't on our exchange. But I think that in general, if we look at some of the activity that's happening, I mean, it's clear that retail is trying to come together to effectuate a strategy in the market. I think we also have to recognize that there are a lot of rules that govern trading in the markets, and so it's important that all investors understand those rules as they come in and participate in the markets. In terms of the role that social media is clearly playing in driving certain behaviors, I think that's another new trend that we've been seeing, frankly, for a while. In fact, Business Week wrote a big article about that a while ago. So what we've been doing within our market. It was a very good article. We actually been investing over the last few years to make sure that we are able to understand what's happening in social media as part of our surveillance operations. So we basically have some tools that track changes in chatter on social media. So if there's a significant increase in chatter on a particular company or a particular situation, then we actually can flag that and then compare that against the trading activity. And if we think that there's something unusual or even worse, nefarious going on, we can halt the stock, and then we will contact the company, make sure there's no news, then engage with the regulators to understand whether or not there's any behaviors that we think we need to investigate further. And that's one of the mechanisms we have as a self-regulatory organization and an exchange operator.
How else are you approaching just the challenge that comes with so much more retail investing, since that has been obviously the root of this phenomenon?
Yeah, and we can also say that that's really the year behind and the year ahead is going to, I think, have a lot of retail activity and a lot of retail participation in the markets. And while it's wonderful to see a whole new set of investors engaging in the markets, directly accessing them, I think it's also very important that they educate themselves and that the industry help educate them on both the risks and the opportunities that the markets present, particularly if they're trying to effectuate some more advanced strategies as a retail investor, as a novice investor. So those are the things that we're focused on: investor education, making sure that our markets are open and available, making sure that investors have instantaneous access to information as the rules provide, as well as instantaneous access to the markets. And if that's the case, then they can all participate on an equal basis and be a part of the markets.
So another topic I want to hit on here is IPOs. And there's been a ton, even so far in January for Nasdaq, 70 or so, I think. What's the outlook for not only traditional IPOs, but also SPACs and direct listings?
Yeah, so what you're seeing today is a new choices being made available to companies as they're thinking about tapping the public markets. They can go public through a traditional IPO. They can be acquired through a special purpose acquisition vehicle, a company called a SPAC. And that will then enter them into the public markets through that acquisition. Or they can go and do a direct listing, particularly if they're not looking to raise capital today. There are some new rules coming forward that may allow them to raise capital in the future. But I think right now it's really focused on those that are not looking to raise capital as they enter the public markets. And what's nice about that is you have a lot of choice. So companies have these new choices. I think it's also important that investors understand the differences. So an IPO has a lead underwriter who does a lot of diligence to make their underwriting decision, whereas with a SPAC, it's really you're leaving it up to the management team of the SPAC to do their diligence on the company and to report all of the known risks and business opportunities in the SEC filing. And then investors actually have a chance to approve that combination, that acquisition. So they have a chance to vote on whether or not they think it's a good deal. So it's very important that the investors take that responsibility seriously as they're looking at what combination is being done. And then on the direct listings, it's a different way for investors to engage, where there isn't an underwritten offering the night before. It's an auction that really establishes price discovery for the company. So investors should understand what that means as they're participating in the markets.
I also want to talk about the sectors that you expect to be most active in, especially, Nasdaq being Nasdaq, such an emphasis on tech and biotech. What are you expecting in some of these new players that we have yet to see go public?
Well, I do think that continues to be a lot of activity in the tech sector in terms of really interesting private companies. We actually had 90 second tenders, which are kind of secondary trades in private companies, go through the Nasdaq private market last year, which is a record number of programs that we facilitated in the private market last year. And then we also, of course, see them starting to think about the public markets. And what's great is we've had a very active issuance cycle. We had 184 operating companies go public last year and another about 120 SPACs go public. And that was all just on Nasdaq. So we are we're very pleased to see that companies are realizing that the public markets are a great way to get permanent access to capital and to provide for new benefits for their employees. I think that at the same time, you're seeing that it's in certain sectors in particular, which, tech sectors, the healthcare sector has been very active. Some of the consumer sectors, particularly tech-driven consumer sectors. So there's been a really interesting plethora, frankly, of companies tapping the public markets.
I also want to ask about board diversity, which has been something that Nasdaq has really prioritized of late, and it's been widely cheered by a number of people, diversity advocates, investors, even some politicians. It's also had a little bit of criticism, and I just want to ask, how did you approach developing those rules?
Yeah, sure. So just to give a little background on the proposal. So as a self-regulatory organization, we have the ability to establish listing rules that govern our market in terms of determining what are the gates that we would put in front of a company before they are able to access public investors through Nasdaq. And last year we decided to put forth a proposal that requires that the companies that are listed on Nasdaq disclose the composition of their board from a diversity perspective. And then we established some minimum standards where we're looking for the companies to try to reach over the next 4 years to have at least 2 diverse members on their board. But the only requirement for them is if either to have that meet the standard or explain why not. So they can't get delisted for not meeting the standard, but they just need to explain to investors what they're doing. I think that in terms of the reaction, the investment community has been universally positive, and you've seen that in the comment letters with the SEC. And then a lot of corporates have also stepped up to say a lot of positive things. And when we've engaged with our clients, they're overwhelmingly positive. But we have some of our clients who we're engaging with to make sure they understand it, understand what it is, understand what it isn't. It's not a hard mandate. And then also to help them navigate through the change. But the fact is that we do think that it's an important element of thinking about governance in corporate America today to establish the fact that diversity on boards creates diversity of thought. And there is an overwhelming number of research reports now that show that the correlation, at least, between more diverse boards, better financial performance, and better risk management. So we think that there's enough evidence today to say that this is the right standard for Nasdaq to establish.
A lot of companies, including ones that are listed on Nasdaq, don't meet those standards. So you mentioned how you're going to have those conversations with them. How will you help get them to meet the new rules?
Yeah, in fact, we've established a whole program that will be available to our listed companies as it's just a service to them as part of their listing to help them identify diverse candidates that meet their requirements. So it's an important thing that every company should have a board that is well qualified in terms of hard skills, soft skills, and background. And so I think that we're very, very excited to work with our companies to help them identify qualified candidates that also happen to be diverse. And we will offer that as a service as part of being listed on Nasdaq. And we already see companies working with us on that, which is really encouraging.
So I have a question from the audience that's already come in. I just want to encourage everyone to continue to ask them. A viewer from Japan asked about cybersecurity on the exchanges. Adina, have you seen an increased activity from bad actors?
Well, we do see, I would say, consistent attempts throughout, on a pretty regular basis to see whether or not that people can find vulnerabilities. And we have a very robust IT security program. We don't spend a whole lot of time giving a lot of details on that because obviously it's important for us to maintain security, but we do have a constant investment. We are always working with new providers as well as a very, very wonderful team of very qualified experts on that on IT security. But it is a constant activity for us, and it's something that we are consistently investing in to make sure that we secure the markets.
So let's talk for a second about the elephant in the room in general, which remains the pandemic, and it's raging not only in America but elsewhere around the world. And how does that link up with your economic outlook? Obviously, vaccinations will play a huge role in that, but when you look ahead for the rest of the year, what's the economic outlook that you're fostering at Nasdaq?
Yeah, such an important question, and it's one that doesn't have a certain answer. But I think that what we're seeing among investors, and as we talk to our companies and other clients, I think there's a lot of hope that the second half of the year looks very different than the first half of the year. It is important to see that all of the governments, including the U.S. government, are really stepping up to bring the vaccines to the populations, leveraging all of the available resources to do that. And I think you've seen more and more activities among governments taking a more active role, which I think is very important. But if we can try to get to the point where we have well-propagated vaccines by the end of the second quarter, I think that is probably in line with investor expectations, so that we can start coming back together. We can enjoy the summer together. We can see our families again. We can go to dinner. We can go to the movies. I think that you're going to see that once it's really propagated, there's going to be just a flurry of activity and gatherings that people are so excited to be able to do again. So I think, travel and other things, it'll take a time to recover as people kind of come out of hibernation. But I am hopeful that it will catalyze the economy in the second half of the year.
So you mentioned the government, and obviously there's been a change in Washington, D.C., and there's also a change at SEC. I'm wondering just, what's your perspective on that as a CEO and someone who also talks to a lot of other CEOs?
Sure. Well, starting generally with the change of administration, I think that it'll be interesting to see how President Biden, where he focuses first. I think we all know that his first focus is going to be on the COVID recovery, fiscal stimulus, but his second focus is going to be an important thing for us to examine as well. And I'm hopeful that his second focus is going to be on infrastructure and, crossing the aisle to come up with an infrastructure bill that really puts money back to work for the economy, that actually makes our cities better cities, that focuses in on those areas of our infrastructure that really need to be modernized and improved, and puts a lot of people to work. So if we can see that as his second focus, I think that we will all find that both in terms of private and public sector, I think we'll all find that that's very, very productive for the economy. In terms of the SEC, which is the regulator that we tend to work with the most, I think Gary Gensler is a very qualified candidate. He's a market expert. He understands the benefits of the markets, but also the perils of them. He understands the ecosystem extremely well, and the balance that needs to be struck in terms of regulation being, I would say, supporting business, but also making sure that it's overseeing the business of finance successfully. So we look forward to his expertise.
Just on the idea of you getting to interact with a lot of various CEOs, I'm wondering, in your conversations with them and everything else that you're seeing right now, what trends do you expect will linger and perhaps just become the norm after the pandemic finally fades?
Yeah, it's a great question. And I've been saying to my team for a while, I don't want to make permanent decisions in a temporary situation. But as we get closer to thinking about what is it going to be like when we all come back to work, and not everyone's going to want to get up and commute to the office every single day. And we obviously have technology available to us that does not make that a mandatory for every job. So I think that you're going to start to see a hybrid environment develop in office, out of office. I think you're also going to see more technology, particularly video technology, being deployed in the offices to make it so those out of office personnel feel more a part of the conversation. And I think that that's going to be a great investment, because it gives employees more flexibility, and it gives employers more flexibility to find employees that may not just happen to live in the city, right, that you operate in. And it could be a really great boom, but there's going to be a transition. Today, we are all out of the office, and therefore we're all in little squares, and they're all equal. When some of us come back in the office and some are out, how do you make sure everyone feels engaged? But also, how do you reintroduce the creativity that I think that we're all missing right now by not being able to hang out and talk casually and to, share ideas? And that's the part that I'm really excited about. But we have to find a way to create that right balance.
I have another question from the audience, which is, does Nasdaq envision setting up an exchanged or a unified market pricing vehicle for new digital asset classes, in particular things like cryptocurrencies?
So today we play a few different roles in the crypto world, but we are not an exchange operator ourselves in the crypto world. But we have created a crypto index with a partner, and we are launching an exchange traded product, not in the U.S. actually, outside the U.S. Associated with the crypto index, which we're pretty excited about. Also, in our Nordic exchanges, which operate in most of the Nordic countries, we actually have some exchange traded products listed on our exchange that have become quite active. As a technology provider to markets, we actually provide a lot of technology to the crypto markets in terms of trading technology and surveillance technology to make sure that they're monitoring their markets properly. And then then we step back and we say, should we be a market? And I think right now there are a lot of markets out there. It's that classic product life cycle, propagation of actors coming in and trying things and then seeing who really becomes the strongest. And I think right now, we didn't feel the need to be a leading actor there, but we certainly will evaluate the space over time. And we look forward to partnering with the exchanges that are there.
So here's a little bit of a meta question for you. You've been with Nasdaq for a while. Nasdaq actually turns 50 next month, right? 50th anniversary of Nasdaq.
That's right.
I'm wondering,
yeah.
how you're going to celebrate that, and then when you look at everything that's transpired over the last year, I'm really curious. What have you learned about markets in light of all that?
Well, first of all, it's amazing to think that I've been with Nasdaq for half of its history. So that's kind of a fun little fact. But yes, it is. It's also just incredible to think that we are 50 because we still feel like a really new company, and we're always bringing new technologies in and trying to disrupt ourselves. So it's a fun kind of way to look at us as being an established player, but we don't think of ourselves that way. In terms of the markets, though, the markets have evolved tremendously over the last 25 years, certainly since I've been here. And it is today, it's a very, very embedded part of the economy. It's a very, the way that we interact today and the electronification of the markets means that it's democratized, as we've been talking about from the first topic, in terms of having retail and professional investors coming in and working together or being a part of the markets together. And I think it's a very important part of the economy in any country to make sure that they understand the importance of markets in raising capital, providing investors an opportunity for returns, and really embedding themselves in the economic growth of the country.
And my last question for you, Adena, in the future, and hopefully for all of us, like it happens this year, but there will be a time where we're back in a new normal. And I'm wondering, what from this time and this experience, just on a personal level, do you hope to retain once we get back to that space?
Great question. One of the things I've actually really enjoyed is slowing down a little bit, particularly on the weekends. Not just racing around and having the weekend gone before it really even starts. So my husband and I have really enjoyed our time together. He's actually an artist and he's a potter, so he's been teaching me how to make pottery. And it's very therapeutic. It's a complete opposite of what I do here. So I really enjoyed that. So I'm really hoping that we continue to have our special time together and we don't just get kind of caught up in the mayhem in the future.
I hear that. Okay, Adena Friedman, thank you so much for joining us for the year ahead.
Great, thank you.
Hi, I'm Tom Giles, Executive Editor for Global Technology at Bloomberg. And today I'm speaking with Chuck Robbins, CEO of Cisco. Chuck, thank you so much for joining us today. Chuck, the pandemic has had a real big impact on a lot of corporations, including your own. We saw on one hand companies cutting back on their demand for services, software, equipment, really reining in as the pandemic took a toll on the economy. On the other hand, in some ways, Cisco benefited from an increase in demand for WebEx, for services and software that let us work from home, let our kids go to school, let us continue to work from home. Can you give us a sense of your expectations for as we come out of this in the coming months? To what extent is that going to reverse? And how is the emergence from the pandemic going to affect business?
Well, Tom, first of all, thanks for having me. I really appreciate the opportunity to be with you. I think, look, we learned a lot going through the pandemic. And I mean, we learned a lot of positives. We learned that this technology can be incredibly effective and our people can be incredibly productive. We learned that people can work from anywhere. And I think that's going to have a lasting impact on where we hire, where we locate our facilities, as well as every company is going to think through that. I think it really made us assess our ability to support remote workers from both a collaboration perspective as well as a security perspective. And I don't think that's going to change. I think the future is going to be one of hybrid work. I think that most employees are going to work 8 to 10 days a month at least from home and be in the office the other times. So as we think about these collaborative experiences in the future, we have to make sure that interactive meetings will have people in rooms and have remote attendees, and we have to make sure that they are productive for everyone. And I think that, the one thing that I think is still outstanding is what does the office space look like when we go back? I could make a case that it's going to look just like it is today, and we need exactly the same amount of real estate because we're going to be socially distanced, and we're going to just have this future belief that we want to just not put ourselves in position where these kinds of pandemics can occur again. Or we could be in a situation where people are saying we truly can reduce our footprint and we'll do shared space when people come to the office. And I think that's something that we still have to watch play out. But there are a significant number of trends that have emerged that will not go back.
How has Cisco changed amid the pandemic? And how have you changed the way your expectations for employees as they come back from the pandemic? How much more flexibility are you working into work schedules, and how much more free are employees going to be to work from home?
Well, we were already fairly progressive in our work from home, situation prior to the pandemic because of the technology that we build. And we actually had a check-in today with all of our employees, and we talked about this very issue. And I did tell them that we would probably have more flexibility post-pandemic than we even did beforehand. And I think it's going to depend on the job. Some jobs require employees to be in the office more than others. I think it's going to depend on the employee themselves and what do they really enjoy. Do they enjoy working from home? One of the comments that I saw today from one of our employees is, it's one thing to work from home when it's an option. It's another thing to work from home when it's mandatory. And so I think that we'll provide a high level of flexibility for our employees as we go forward.
Chuck, I'd like to talk a little bit about the new administration. We've seen a real change as Biden has come into the White House, and I'd be curious to hear from you on what changes do you expect to happen as the new administration comes in, and how do you expect their stance toward the technology industry to be different from that of the preceding administration?
Well, I think that as we've gone through this transition, the administration has been very active reaching out to CEOs, to all of us, wanting to begin a discussion and have a dialogue about how we work together to solve some of the problems in the country as well as attack some of the opportunities. So I think the first thing I would say is I think there's going to be a real constructive dialogue between business and government. I think that the administration believes and understands their commitment to science as it relates to the pandemic and the vaccines has been very clear. I think they will take the same approach as it relates to technology and what does technology enable relative to digital infrastructure in this country, relative to broadband, relative to bridging the equality divide. And I think that they will also look to the private sector for us to help create skills in this space. I think that all of us have the opportunity to go out and educate and bring people in this country into the environment where they have technology skills, which every job in the future is most likely going to require some element of technology skills. And we have the ability to go into every area of the country now as industries and actually educate people on that opportunity. And I think when you combine that with this belief now that people can work from anywhere in many jobs, I think it will give us an opportunity to leverage technology, create skills, and then hire people all over the country in areas that we wouldn't have thought of in the past. And I think that's going to be a powerful opportunity for all of us.
Chuck, you talked about the things that you would like companies to do and ways that corporations like Cisco can contribute to the recovery. What do you need from the government? What's your message when you get that call from the Biden administration on what corporate America needs in order to help America get back on its feet?
Well, business needs predictability, first of all, and we need to work together to create jobs and get the economy back on track for all Americans. And I think that's an important part of what we need to do. We need to deliver broadband to every citizen in this country. I think the pandemic has definitely highlighted, as students and young students have tried to work from home, it has highlighted the lack of technology and the lack of broadband that many of the families in some of the underserved areas of our country, that it's highlighted the need to deliver that broadband. So we need to work together to deliver it. We need to continue to focus on emerging technologies like 5G and the build outs here in the United States. And as we think about infrastructure, everything we think about should be digital infrastructure, even if it is in the categories of traditional, physical infrastructure like roads and bridges. Let's work together to make sure that those are smart roads and smart bridges, and that we implement the technology that's really going to take us into the future.
What needs to happen still? I would have thought in the year, 2020, 2021, we wouldn't be talking about the digital divide, that we would have maybe overcome some of those obstacles. Why is it that we find ourselves in a global pandemic and so many people are still lacking the infrastructure? So many people are still lacking the connectivity that they need in order to get their work done, make sure that their kids are able to attend class without interruption. Why is that? And what are the obstacles that we still need to remove as a society?
Well, I think there are a couple of issues that exist. One is just pure high-speed connectivity, and there are many areas in our country that the economics alone would never incent some of our communication services providers to actually go build it out, because the ROI on the investment isn't there. And that's where it's going to require, joint funding between the government and the private sector. And I think in some of our inner city areas, it's just an issue of poverty, and it's an issue of the inequality, and people just don't have the technology. Even if they do have high bandwidth available, they may not be able to afford it. They may not have the appropriate devices to actually then connect and experience this virtual learning environment. So it's a number of issues. We know what they are, and we just need to work together to figure out solutions.
What about the regulatory environment that, we saw a very, sometimes very harmonious and sometimes very strained relationship between the previous administration and the tech industry as well as others. How do you expect the regulatory environment to change under President Biden?
Well, first and foremost, I think that the technology industry, we have become a core, backbone element, whether it's the technology we build, whether it's the platform players, have become the foundation for the global economy. Much like the banking system is critical, much like the energy systems are critical, the technology systems are critical for the global economy to operate. And so the notion that it needs to be regulated, to me, is quite obvious. And I think the opportunity with the Biden administration is, I think there's an opportunity for a real candid dialogue, a real open dialogue, and for us to get to some practical regulatory, strategies. I have said in the past, I actually feel, quite sorry for the folks in Washington and in other countries around the world who are trying to keep up with this technology as a side job and actually apply regulation against technology that's moving so rapidly. And I think it's going to require us to spend time together to educate each other and actually work together to come up with the appropriate regulation in today's world. But it definitely needs to happen.
It's hard to look back on 2020 without reflecting on the racial reckoning that we saw across the country in light of the events surrounding George Floyd's death. Cisco was one of the companies that took a real strong stance talking about the need for real change, talking about systemic racism. How do you take that in a world where there's not even agreement on whether there is systemic racism?
Well, first of all, I think that as CEOs, I don't think we have the option of sitting on the sidelines any longer. I don't think our employees, our constituents, no one's going to allow us to sit out these discussions. And I think it's easy to be out there and be bold when things are going well and things are working in your favor. But when there are complex issues, I think it requires all of us to step up, and it requires us to all be clear when the answer is obvious and when the situation is obvious. We need to exert leadership. And I would say that 2020 was a year where we needed as much leadership as we could possibly find. And many of my peers and colleagues were out there. We had lots of discussions with each other through venues like the Business Roundtable, where we shared thoughts and ideas about what we were thinking. And we just tried to come together and be a positive force in the midst of a very complex time. And I think that, we did. Now, look, everybody has their own opinions, and certainly social media gives everybody a platform to express their opinions. So you can expect that kind of thing. You can expect some negative comments, but I think that's what leadership's about, is when it's a tough situation, you stand up for what's right. And when it's just so clear, it doesn't matter what people say. You just have to do the right thing.
And one of the things that you've said in public statements is that, there's a lot more work to be done. Can you talk a little bit about what that work looks like, and what is Cisco doing to help make that change come about?
Yes, we have a team of people that have worked really hard on putting together our social justice strategy and the subsequent initiatives that we're going to be driving, the investments we're going to make. And that work is ongoing. And I can tell you it's a group of very energized employees who are going to keep it moving forward. And I meet with them regularly to just get updates and make any decisions that we need to make. And I think that that's what every CEO needs to do. It's no different than an important business project that you would be running inside your company. You're going to stay close to it. You're going to create accountability. You're going to create milestones, and you're going to inspect it. And I think we have to look at this in exactly the same way. And I think that's the way we're doing it, as well as most of my peers are doing it.
I want to get back to your business a little bit and talk about the transformation that Cisco has been undergoing over the last several years, where you're trying to transform your business from being a provider of hardware into one that's much more software and services oriented. Can you talk about the milestones that you've achieved in that effort?
Yeah, Tom, it's a great question. So in 2017, we did an analyst conference, and we set a target of having greater than 50% of our business come from software and services by the end of fiscal 20. And we achieved that. It was 51% at the end of our fiscal year that just ended. And we're currently working through sort of what are the next wave of milestones that we will, take forward to the street. But I think we have made great progress. We had when I became CEO, we had about a $3.3 billion SaaS and subscription software business, and we exited FY20 almost at 11 billion. So we have added to that very significantly. We still build great hardware. These massive 5G networks, where we're working with 30 providers around the world today, they need high-speed, high-performance hardware to run these backbones of these networks. So that's not going away. But to the extent we can solve problems for our customers with software, it's just faster and it's easier. And we're going to continue making the move in that direction. We'll continue adding more and more software assets to our business. But I think that we've made a great deal of progress. We still have a ways to go, but I'm proud of what the teams have done.
So to reach that milestone in 2020, can we talk about what's next? What do you do? What's the next big milestone, and how long before you're ready to start outlining that in your conversations with investors?
Yeah, we're going to look at a whole series of new metrics around a lot of our SaaS businesses in particular, We're going to get more consistent with reporting of metrics like incremental ARR and the real metrics that traditional SaaS and subscription companies would report. We have a great new CFO, and Scott Herron, who joined us from Autodesk. He and I are going to spend several months building out our model, looking at the implications of a lot of the investments that we're making. And I'd say middle of this year, hopefully we'll be prepared to have a broader discussion on that very topic.
Lastly, I want to talk about the 5G rollout. You're a company that provides the services and the hardware to those companies, those providers that are at the forefront of this rollout. There was a lot of hype behind the 5G and the ways that it would change the way we work, the way we play, the way we interact with machines, and the way those machines change our lives. I'd like to hear from you your sense of why, for some, has the 5G rollout been a disappointment? Why is it not living up to the hype?
Well, I think it's a matter of timing, right? I think that it will live up to the hype. Trust me. I think we're just in the early days, and it's going to go through phases. And right now, the big rollout that you see happening right now is for the consumer handset 5G services. And if you just go back to 2007-8, when we had the 4G transition, at the time, you could have said the same thing. And then what happened is once it rolled out, you saw all this innovation, you saw smartphones, you saw new applications being built, streaming became a real viable technology. And I think that we're on the very front end of deploying the 5G technology to the consumer. I think our customers will build out 5G enterprise services, and then I think you'll see a lot of innovation follow. We don't know what that's going to look like, but I think the performance, the low latency, and the inherent value that has been hyped, so to speak, about 5G, I think it will come to fruition over the next few years. And we're just in the early days.
This is Tom Giles with Bloomberg News, and I've been speaking with Cisco CEO Chuck Robbins. Chuck, thank you so much for being with us today.
Thank you, Tom.
Hello, my name is Eric Balchunas, and I'm Senior ETF Analyst for Bloomberg Intelligence. And today I'm going to be going over the ETF landscape, which includes mutual funds. Our team covers mostly ETFs, but we also work in the mutual fund industry because a lot of the same companies are issuing both products. So, and I think it's very relevant for my presentation today, which we call the battle for active. We know that ETFs have taken in a ton of money into what we call cheap beta, Vanguard, BlackRock. They clean up. They've taken about 70% of the cash every year, but there's about 30% left over for active. And a lot of bigger legacy mutual fund companies are starting to come in and try to get a piece of the ETF action. And I think that's what the big theme for us is going to be next year. So let me go through some slides here. Last year, ETFs took in about $500 billion, which was a record. We think next year they'll probably pull that off, but they could even go to $600 billion if you consider what we call the big active bump. These would be flows coming in from these big mutual fund companies that are sitting on upwards of $10 trillion. They have a lot of money, but they have organic growth problems. So they may actually bring over some money to get something going in the ETF space, and that could be worth about $100 billion. I'll show you how we get there. First, the problem for active mutual funds is they have no growth. Their assets are fine. They've gone from $3 trillion to $6 trillion over the last 10 years, but that's only because the market's up so much. Flow-wise, they lost $2.3 trillion in outflows. So it's kind of a mirage situationally, and a bear market could really see their assets decline quickly, we think. So right now they're reading the writing on the wall, and they're going into ETFs to try to appeal to younger investors, RIAs, and try to get their strategies in those hands. So one way, one other slide I want to show is just that right now in the equity world, half of the assets are now passive in terms of fund assets. So again, this is part of that idea that at some point you're going to have to sort of move over and try to get a piece of that action. So here's some of the companies that are going to be coming over into the ETF world through active non-transparent, or ANT ETFs as we call them. Basically, they're just like ETFs, but they don't show their holdings every day. And this is a big deal. The SEC approved this structure, and it's going to allow these companies to not give up their IP or be front run, yet take advantage of the ETF, namely the tax efficiency. So you can see just in the equity side, there's $1 trillion coming over potentially. And we look at the ant race so far. There's about 12 of them out. They've got about $1 billion. They haven't really set the world on fire. We didn't think they would. It's tough to get assets in ETFs. And their active share is interesting. This is something I want to talk about throughout this presentation, is a little higher than it is on the mutual fund side. And we think that's probably smart. That said, their fees are going to make it difficult. A lot of the money goes to funds that are charged less than 20 basis points. So when you're at 40 to 60, it makes it tough. You have to perform. So besides active non-transparent, another way that mutual funds are going to come over is through conversions. They're literally going to just convert a mutual fund into an ETF. The SEC should approve this. DFA has announced the first one. That's going to be $32 billion. It's a tax-managed fund. So these investors will go to sleep one night with a mutual fund, and they will wake up with an ETF. And there's been 3 or 4 other companies who have followed suit. DFA is a leader, and we think that ultimately 30 plus maybe another 20 billion. So 50, 60 billion could come over in just conversions alone next year. And here's the thing with all the ETF flows generally go to 1 or 2 places, dirt cheap or shiny objects. It's not so much active or passive. It's just those 2 things. Here's the deciles of flows between cheap and expensive and best and worst performing. And you can see upper left obviously is good, but on the far right, if you can crush it, if you can do really well, you can overcome the fee obsession that these advisors have and retail investors. So we try to explain to people that those are the 2 places that flows are going, and they should really design their products accordingly. The middle is the tough spot, and this because portfolios are changing. Most people's portfolios now are barbelled. They have real low-cost, cheap beta as the core, and then they take some chances on the outside. And of course, they're going to want something very different when they take those chances. We on the team frequently refer to it as the hot sauce. We look at ETFs being designed for this pop potential, which we call the hot sauce, so to speak. If you look at all the launches in 2020, the number of holdings they have is shrinking. In other words, they're more and more concentrated so that they can actually have more of a chance to not just beat the index, but really beat it and get some attention. And again, get some of that shine going that is required. At least that's what the flows are showing us. Now, no better example of this shiny object than ARK. ARK has gone from 4 billion to about 44 billion in less than a year. That's a 10-fold increase. I put PIMCO in there, who's no slouch. They have a good ETF business, just so you can see how crazy ARK's rise has been. And ARK is high cost, stock picking, and they're independent. So any one of those 3 things in the ETF world makes your life pretty difficult. They're all 3, and they found success. And they did that because they are shiny objects all over the place. They have a couple ETFs, and all of their strategies seem to be working, whether it's the main flagship fund or the genomics fund. Even the 3D printing ETF is starting to find a little pop lately. So you can see how much these funds are not just beating the S&P and the Qs, but they're lapping them. And that has been the deciding. Now, of course, we know this might not last. The Janus 20 was a big deal 20 years ago. That fell on hard times. We've seen this where these high flyers do come down to earth. And so we're not saying it will last forever. We're just saying that tends to be what attracts flows. Now, DFA is interesting. They're not doing ants. They're going to issue transparent active, but they're also going to do it cheap. And so their active ETFs are 12 to 15 basis points. So again, because they're dirt cheap, we think they have a good chance. And they've already seen some inflows since they launched. And it's interesting, Goldman took this route too with their smart beta. GSLC is 9 basis points. And that has been very good. I think last I checked, it's around the $10 billion mark. So again, if you sell an active brand name active strategy for Vanguard fees, you're probably going to succeed. That's another way to do this. And if not, there's always BYOA, which is bring your own assets. And this is where if you have a network of advisors, or you have some in-house money, or you just have mutual fund investors that you can bring over, this is a look at issuers by their percentage of assets that are in-house or internal assets. And you can see some issuers do it a lot, some not so much. But again, we think maybe upwards of 20 billion could come over next year through this BYOA process. And all this big active, these traditional active managers are coming over, and whatever route they choose to go, organically, they're going to have to fight what we call new active. So new active is using an index, it's rules-based, but it's definitely doing an active strategy. That would be thematics, smart beta, and ESG. All of those are deviating from the benchmark. And you can see that in the last year, smart beta has really lost market share to themes, ESG, and stock picking, namely Cathie Wood, and ARK is that white bar there. And so we think smart beta, which for years dominated this sort of non-beta portion of the pie, is now going to be a much more competitive place. You can see here, this is the pie. This is what everybody's going to be fighting over, because this is where you can actually make some money. That's 25% of the ETF pie. The other 75% is basically going to fees that are less than 10 basis points. So if you're looking for revenue, not a lot of action is going to happen there. So largely the innovation is going to be for this slice of the pie. And that's what we're seeing. And now real quick, this has almost nothing to do with what I just talked about, except for the fact that it was a big issue and something we're watching next year as well. The S&P 500, we feel, probably took a hit to its brand. Adding Tesla so late, delaying it, and reminding everybody that this index is run by a human committee. And it kind of proves there is no such thing as true passive. That's why we like to go with dirt cheap and shiny objects rather than active and passive. So the S&P still gets a lot of flows because those indexes and ETFs are very cheap. But look at how the S&P lagged other, quote, beta indexes, namely the Russell 1000 and a few others. Qs, obviously, that's not quite beta. But this is a year in which it reminded us that not all beta is the same. And the S&P lagged what would be considered straight beta by about 100 basis points because it added Tesla so late. And in the past 6 months, all the S&P 500 ETFs and indexes have seen outflows for the first time in a long time. You rarely see them see outflows. So we think some of this money could go over to the total market indexes like VTI, which has held Tesla for 10 years. You don't have to worry about when those stocks are getting added. So that's something to watch too, is this sort of battle for beta. That's a sort of a separate issue. But largely, I think much of the action is going to happen in this battle for the slice of non-beta cash, which again is about 30% of the inflows each year. So with that, that's what we're watching. If you need to reach out to us, here's our email, our Twitter handles. We interact with people over there too. And if you are interested in podcasts, I co-host one called Trillions on the ETF industry and highly recommend it. It's on iTunes. Thank you very much.
Hello, everyone. I'm Peter Grauer, the chairman of Bloomberg, and I am delighted to welcome everyone here today. Although we can't be together in person, an event like this reminds us of what connects us and the values we share, even at a distance. Now in its 6th year, the Bloomberg Gender Equality Index, or GEI, has been shedding light on a previously dark area of ESG reporting among public companies, gender-related practices and policies. And as more companies have come to recognize the business case for fostering an inclusive environment, the GEI has grown year over year. This year's index is larger than ever. 380 global companies spanning 11 sectors, headquartered across 44 countries and regions, have taken part. For the first time, companies domiciled in Indonesia and Bermuda are reporting gender-related data, and we're delighted to welcome some incredible new participants, including our good friends at BlackRock and Nasdaq. Not only are more companies disclosing data than ever before, but the quality of disclosure continues to improve. For example, GEI companies had a 94% disclosure score on average. And although we raised the threshold for inclusion in the 2021 index, we are still seeing record numbers of companies disclosing data. The past 12 months have been hard on everyone. And increasingly, we are seeing that the S in environmental social governance, ESG data, has become more important to companies than ever before. Firms that provide an inclusive environment, supporting work-life balance and flexible work arrangements, will eventually succeed in retaining a talented workforce and gain a competitive advantage in a business environment that has been significantly altered by COVID-19, possibly forever. I want to close by thanking companies that are committing to solving the important issue of gender equality by disclosing data on their efforts to support gender equality through policy development, representation and transparency. Their efforts are creating accountability within their industries, collectively driving real change. I wish everyone a healthy and profitable 2021, and I'm looking forward to the rest of the program. And now I'd like to turn it over to Patricia Torres, Global Head of Sustainable Finance Solutions at Bloomberg, to provide some further insights into this year's GEI. Patricia?
Thank you, Peter. I'm happy to be here today to share with you some of the highlights from this year's index. As Peter mentioned, in today's virtual working world, it's more important than ever that companies maintain a strong corporate culture, as the decisions companies make today can drive progress on equality for years to come. This progress begins with the GEI. By using our framework, companies can see where they are relative to their peers and hold themselves accountable to disclosure and workplace equality. Investors can use this information to gain a comprehensive view into how these practices are increasing employee productivity and talent retention, and therefore contributing to a stronger financial performance whilst driving positive change in local communities. I would like to leave you with 5 highlights from the 2021 GEI survey. First, GEI companies are reinforcing their commitment to an inclusive work environment, with 87% of companies included in the GEI providing flexible working hours. Second, these companies are working to close the gap through female leadership. On average, 29% of GEI members' boards are women, and more than half of the companies require a gender-diverse slate of candidates for management positions. Next, these companies are hiring more women than they are losing, and 69% have specific strategies for recruiting more women. These firms are also addressing equal pay, with 59% conducting a global gender-based compensation review and 40% publishing their global results by gender. And finally, they're investing in their local communities. 54% of firms sponsor programs educating women in science, technology, engineering, and mathematics, or STEM. As these numbers show, these firms are taking their commitment to gender equality seriously. And now you can hear directly from one of the GEI members. You can learn more about the GEI framework and 2021 insights on bloomberg.com/GEI. Thank you for your continued support, and please enjoy the event.
Hi, I'm Jackie Simmons, Senior Executive Editor for the Americas at Bloomberg, and joining me is Mindy Grossman, President and CEO of WW International, formerly known as Weight Watchers. So Mindy is a trailblazer in the consumer space when it comes to building and growing brands. She knows brands. She's worked for names from Nike to Polo, Ralph Lauren, Tommy Hilfiger, and many others, a real businesswoman in her own right. And as one of the 380 companies in the Gender Equality Index, or GEI, WW has been part of this for 2 years. And so I thought maybe we would start there. You know, one of the metrics where WW scores highest relative to its peers in the GEI is for inclusive culture. What's inclusive culture? That's everything like initiatives including benefits and parental leave. Mindy, we only have your data for 2019 for that metric. So I thought maybe you could tell us a little bit about what happened in 2020, a year when benefits and flexibility and parental leave were primordial to working parents and especially for working women.
Sure, Jackie, and great to be here. I think what's important is the core fundamental and acute reason that you really need to embrace diversity and inclusion at all levels of business is something that I've embraced throughout my entire career. Whether it was starting Nike's first Women's Leadership Council, working on, with Catalyst on inclusion surveys, or in every company that I have joined or led, making that a core fundamental foundation of what's going to create business success. And I believe that those organizations that embraced it even that much more significantly in 2020 are going to accelerate their ability to attract talent, to be able to have greater business success, and to have greater innovation. And what we really did in 2020 was we invested more. Given the environment, there's nothing more important today than creating a culture that will attract talent, develop talent, and retain talent. And utilizing your listening skills to understand what's happening is really critical. But diversity is one thing, but creating a truly inclusive environment where people feel valued, where people can have, you and I were talking yesterday about the expression I like so much, you can have conversations that allow for productive discomfort because you have diversity at the table. The second thing that we've been very focused on is diversity at the board level as well as within the organization. So if you look at our board today, even compared to where it was 3 years ago, we have 6 men, 6 women, 2 Black women. My team is diverse, and that affects the entire organization of how inclusive people feel. And you brought up the issue that a lot of women in particular are facing throughout what has happened with COVID, with disruption of lives and families at home and kids not going to school. That division of work has really become tilted. And when you look at the recent numbers of, 2 million coming out of the workforce, that's a frightening statistic. And I think you saw the other day, actually yesterday, I was part of a group of 50 leaders, female leaders, who wrote a full-page letter in the New York Times to really talk about there truly needs to be a Marshall Plan for moms. And as employers, we have to support, but we also need the support to come from elsewhere, or we are going to lose progress on everything we've done to ensure diversity as a core element of business success.
Yeah. I mean, you kind of tipped into the next question, which is really about life and lockdown and all things pandemic. And, the impact of COVID on women in the workforce has been, a really harsh reality. Women accounted for the vast majority of jobs lost in December. But the data also show that the impact on female jobs that were lost happened where flexibility was not possible. And so how do you think about the challenge of retaining female staff as we all hopefully get vaccinated and start heading back into offices?
I think we're never going to go back to the way we used to work. At least I hope not. Fortunately for us, we were a pretty flexible workforce organization, very Zoom, Slack. We have a lot of product tech, et cetera. But we really felt that if we truly value talent and we trust talent, we have to give them the flexibility to do what they need to do as long as they feel confident in being able to do their job. And as we move forward, to your point, even with a vaccine, we're going to remain a very flexible, part remote workforce, but we'll all be more purposeful when we get together. And I think, giving talent the ability, right, to be able to manage what they need to do is part of how you build a culture that you're going to retain.
Sure, but we ran a lot of headlines the other day citing some finance professionals. They had some companies in the Wall Street space saying, you know what, the work from home is not sustainable. People need to get back into the office. They need to bump into each other at the water cooler. They need to be around other colleagues. I mean, how do you calibrate that with?
I am not saying that there is a need for interaction, right? I absolutely believe that. You want to be able to get in a room. You want to be able to have those conversations. You want to be able to have those offside, commentary. I think that's very important. What I'm saying is that to do that, we should be more purposeful. So think of the environment we come back to as almost part library where you come in and do your work, and part event and meeting space where you're coming together with a reason and a purpose to be in that room. And I think people really want that. They want the ability to be able to have those conversations.
Got it. I mean, just going back to GEI for a second, I mean, your female leadership score was little change between 2018 and 2019. You were still above average, in the index. But, many people, we talked about this, assume a company like WW, whose business model holds a lot of appeal for women, will be, naturally tapped into issues around equity, both gender and demographic. So when you think about sort of a COVID economy and how that's exacerbating inequities within demographics, including women, what are you hearing from CEOs, and especially male CEOs, about the urgency of narrowing that gap?
So I think it's critical. And I think those CEOs, whether they be male or female, who are enlightened enough to really realize that having a diverse team is going to give you greater business success. You're going to be able to have the conversations. You're going to get diverse point of views. You're going to attract more talent. All of that is critical. I think the other thing is the assumption, because you primarily service women, is you need all women, right? No, you still need diversity to get different perspectives. We're a global company. We need global diversity. We need, if you think of all the elements of diversity, even of our member base, age, race, gender, geography, life stage, all of those things. And you want to make sure that you have a seat at the table and you're taking into consideration everything you need for your business. And I think that is really more critical today than ever. And again, I said it earlier, don't think that if you want to attract talent, that's not something that's going to be looked at in a very significant way.
All right. I want to talk a little bit just about, again, in a COVID moment, I want to talk about WW's business model, because, COVID boosted demand for home fitness equipment and definitely fitness apps and all things digital. I admittedly have gone onto the App Store on my Apple phone and downloaded a couple of fitness apps. There's a lot out there. How do you stand out?
Yeah, so we have been, committed. And when we came out in 2018 with, our new mission and vision of truly democratizing wellness, and part of that was the significant investments in technology to have technology plus meaning help people live better connected lives and truly build an ecosystem of wellness, never abdicating our leading position in weight loss, but giving people a complete tool to help them build sustainable, healthy habits. And that is more important now than ever. And what we've seen, because we see behavior in real time, we see what's happening is people are doing what I call a radical reassessment of how they live, how they work, how they play, what they value, and how they spend. And health and wellness has kind of like the hierarchy of needs, has elevated significantly. And people are looking for what they can trust. Wellness is not a luxury anymore. It's a necessity. And we've certainly seen that during COVID. So for us, we've used this time to accelerate our investments and our innovation. So just in the last number of months, we launched MyWW Plus, which is our newest innovation that completely personalizes your experience using AI, machine learning, and marries you to an experience that's right for you. We launched Digital 360, our newest membership tier that not only provides everything and those tools, but also is on demand 24/7 coaching, content, built on community. And I think what people are looking for now is A, trust, B, value, but C, something that is going to be with them for their long-term journey. And we definitely see that's what people are looking for right now. So if you look at what we last reported, our digital business being very strong, now launching D360, and there was and still is part of our business that incorporates face-to-face as well. Obviously, we've had to move that to virtual workshops, and we were able to do that because of the investments we made in technology and, all of the innovation. And to your point, certain people are still going to want that face-to-face interaction, and we're going to be able to provide that to them.
I definitely want to come back to the innovation and the investments, but I have a question from the audience about some comments from our earlier part of discussion, which was about the unemployment numbers for women. This person says they're devastating. What can companies do to find those women who have left the workforce in 2020 and recruit them?
No, I think that's going to be very critical. And, I know that I've had a number of conversations with other CEOs on, how can we create forums to be able to identify and really understand. But I think the other thing that's important proactively is within our organizations, because, we've had women leave the workforce because the workforce has narrowed, but we've also had a lot of women leave the workforce because of family issues and because not having the flexibility. So I think within our own organizations, we have to be proactive in being able to identify solutions, whether they be time solutions, financial solutions, support solutions, so we don't lose the talent that we need to have.
Right. I mean, here's another question, just in terms of accountability, in terms of bringing in diverse talent and more women. When you have exchanges like, Nasdaq, which are proposing to hold companies account in order to do business with them, my question is that the role of the exchanges, or should companies be doing something differently themselves to find ways to hold each other to account?
So my answer is both, right? I think I'm a big fan of what Adina did, and obviously our board reflects that. But I do think that you have to be very purposeful and measurable. So, for example, when I was at Nike and we really had to identify how could we have greater gender representation, we did an inclusion survey, identified how we had to bring women together, but we also put in place, you could not fill an open position unless 50% of the qualified candidate pool was diverse. And then you had to hire, and then you had to measure, and then you had to incentivize your leadership on the diversity of their pipeline. And if it doesn't come from the CEO, it is not going to be embedded into the culture. And inclusion is a skill. And you can have diversity, but you also have to work just as hard at inclusion. And so your board has to reflect that, your leadership team has to reflect that, and your culture has to reflect that.
That 50%, candidate pool rule that you developed, decades ago, is that something you use today within WW?
Yeah, we ensure diverse pools for all our roles. And, it's our way of doing business, right? So, it's embedded throughout the organization, which is how leadership is, measured and how it's embraced. And I think it's of critical importance.
So, with the few minutes we have left, I said I wanted to come back to the innovations and new products, which you talked about, that, spelled out nicely. But when you think about innovations and new products, are there new opportunities in 2021 to partner with other firms in the wellness space, or even buy, a rival in the digital, product area?
So I'm a very big fan of partnerships, authentic partnerships, where together you're going to create greater impact than if you did it on your own. A great recent example is we announced Sharon Lighty, who's the CEO, and I announced a partnership with Vitamin Shop. And it's not just a product partnership, but it's product experiences within their retail formats. And she's also partnered with us as part of the Healthy Living Coalition, where there's now 20 businesses in both the public and private sector that are really committed to closing the real disparity gap between access to healthy food, so around advocacy, action, and investment. So, she and I like to say a great partnership is authentic, and 1 + 1 = 10 if you can identify what you can really do together to have impact. And so, we look for those opportunities to be able to partner, and to your earlier point, at times acquire businesses that are going to help us accelerate our efforts.
Is there anything specific you're thinking about, in the next sort of 12 months?
Well, we're very focused right now on the diabetes space. We just brought in Dr. Adam Kaufman as our head of diabetes. We have a big focus on our new membership verticals to be able to provide more support, and a very big focus on personalization and really being able to make every journey individual to the unique person.
And when we look forward to more announcements there, really with just a minute and a half left, I want to quickly ask you about your subscriber numbers, because they looked really good in Q3. You also added higher margin digital products. Revenue contracted. Some of that, I think, was probably owed to the studio business. Very quickly, Can you tell us a little bit about what that business is for people who aren't familiar, and what's the outlook for the studio activity?
Sure. Well, as you saw at the end of Q3, obviously with our studios closed, and that being a higher business, there was some revenue pressure. But we were thrilled to end the quarter with 60% gross margins because of the high margins of our digital business and now D360 and what that flow through was. So we will continue, with a lot of the closures to just be able to maximize our digital platforms, but really continue to be able to build our subscriber base as effectively as possible.
I would be irresponsible to not ask the question about Oprah. One of the more prominent voices, not only for the firm and face of the firm, but she's on your board, an investor. Can you just tell us in the last 30 seconds, what can we expect from her contribution to WW in 2021?
Look, Oprah's been an incredible partner to me and to the organization, and she's a great example of kind of ultimate discretion and what she puts herself towards. I think everybody knows we did that incredible tour with Oprah at the beginning of 2020, 9 cities in 9 weeks. And then we also launched a significant virtual tour, because right now galvanizing people to do the best for themselves is important. So look for things to come from us with Oprah.
Okay, and on that note, Mindy Grossman, thank you so much for your time. Thanks a lot.
Thank you so much, Jackie.
Thank you all for joining us for the second day of the year ahead. We hope you enjoyed these conversations. Thanks again to all of our speakers for a wonderful program. And thank you to our sponsors, Alex Partners and IBM. And most of all, thank you for being such an engaged audience. To rewatch any part of this event, you can come back to this website where the recordings will be uploaded. You can also access videos of all interviews on Bloomberg Live's YouTube page. The year ahead continues tomorrow, January 28th. You can check out our agenda on BloombergLive.com. We do hope you will join us again.